for. But let's expand this conversation, bring in Kevin Green, senior markets correspondent here. Kevin, KG, I mentioned the fact that, we don't have any clarity on any deals that are done, right, at this point. Keep on, kicking the can down the road on that front. But my take on this still is, KG, that even with the data that we've seen, the earnings that we've seen, none of those have been impacted by tariffs because none of those tariff headlines and risks weren't out there yet when we're getting either the data or the earnings, right?
But Tom, you are seeing it in the guidance for a lot of these companies. So we have to keep that in mind as well, right? At the end of the day, it is going to be very hard for the market to really try to navigate what the Fed's going to do as well as the administration. And you're right, we haven't seen any deals yet. And, the market really only cares about maybe 3 countries when it comes to deals. Japan, which their commentary and rhetoric lately has been a little bit more standoffish than I would have expected. Then you're worried about the EU. We know that they do have potentially a plan to tax around 100 billion euros worth of U.S. goods if trade talks do fail. And then you have China. And I still think that's just a murky situation there. So I think there's a lot of uncertainty when it comes to the policy itself. I think the market right now, though, has been able to at least accept the fact that we don't have clarity there. And hopefully it's really pricing in that we'll see incremental progress over time. And I think it's realistic to understand that we probably will get frameworks of deals. These probably will not be actual trade deals that are certified and approved by Congress, because that can take a year, 2 years for that to happen. The frameworks of the deals probably will give us enough confidence here, or at least for the market, to try to push forward. Jerome Powell, he's not being political. It is difficult. The highest tariff policy that we've seen since 1930 in an economy that's dramatically changed since then. We haven't seen the impacts of inflation yet, if we're going to see any, but the writing has been on the wall. I mean, look at the ports, the LA ports. Everybody's talking about that. A significant drop when it comes to volume there in shipments. We probably will see some issues when it comes to the supply chain. You still have inflation relatively sticky and a labor market that is actually holding up. So I don't know what anybody really wants the Fed to do right now, cut rates in the midst of something that you don't have a clear reason or even clear guidance of what's going to happen next. That makes it a little bit difficult. For the bulls, though, they could actually ease up and maybe set the stage for quantitative easing policy to be at the ready in the event that something does happen. And that type of rhetoric or language is what I'm looking for tomorrow. And that probably will be enough for the bulls to get excited about the Fed potentially going to take action here in the future. But for now, he's in a rock and a hard place. If you're just looking at the data, it's really suggesting right now that you have to pause for now.
Kev, when you listen to KG's comments there, it's like QE? Are you kidding me? Why would they even need QE at this point, just due to the fact that, hey, the economy's still humming along? Besson even said, he goes, we expect revisions to that lower than expected GDP number. Remember that? He came out and stated that today. He doesn't see a recession on the horizon. I mean, you start talking about QE, there's more underlying fundamental problems out there, isn't there?
Well, I mean, if you want to start QE off sentiment data, I guess that's one way to run an economy. But if you're looking at the hard data that says, look at crude oil since April 1st, right? How you think that's not going to lower the overall headline inflation number? It is. It's going to significantly. Jerome Powell's got 2 mandates, right? Remember, 4 years he stayed out of politics as $4.8 trillion in spending went through the system. And he took the blame for saying transitory when they spent all that after he said that. Yeah. He still took the blame, stayed silent. 3 months into a new administration, suddenly he turns political and he starts commenting on future levels of the economy. Why doesn't he talk about crude oil? Why doesn't he talk about wages? CPI, PPI, PCE, all lower than they were a month ago. That's the hard data. That's what he should be looking at. And that gives him the door to do a maintenance cut so the Fed funds rate isn't as restrictive. If you want your smooth landing or soft landing, you've got to lower rates as inflation comes down, and it's coming down.
Kev, it is mind-blowing that you think that the markets and what we have seen as far as economic data is showing enough signs to be able to cut. In my opinion, it just seems very difficult. Jerome Powell trading off energy markets is the last thing that I want the Fed to be able to do right now. And the crude oil markets have multiple factors that are pricing in an economic slowdown, as well as the pressures from OPEC plus increasing supply. So I think you need to discount that for now. And it will be a problem as soon as we start getting rigs coming back down and we start seeing production being tightened up. Diamondback literally just talked about that this morning. You're going to tighten that supply up, and any type of economic growth is going to spike those prices higher. And I think that's exactly what they're going to do, or what they want to avoid for now. Tariff policy is not being political. Tariffs are a tax. There's a reason why the administration pushed back on Amazon and said, "Oh, don't show those prices." There's a reason why. So I think they're doing the prudent thing right now is waiting for the data. The hard data has not really reflected tariff policy. Soft data has not. Last thing I will say, quantitative easing, you guys can laugh about it, like it or not, has been a more effective, and tightening, by the way, has been a more effective tool in the last 2 cycles than cutting interest rates. Interest rate policy right now is doing nothing to help the consumer because a lot of the costs that we have, the bigger purchases, are going to be fixed. They're not really floating rate exposure for consumers. So QE is probably the best policy for them, and they can shore up the treasury market with QE policy. And I'm not saying they should do it. I'm just saying at the ready. The problem that they had as far as the administration, they pushed back and they did an about face when the credit market started to break. Right? Nothing else but the credit markets. Now, if we are going to see some fracturing with the credit market, you'd like to see the Fed really try to step in. They should set the stage for that in the event that this thing does get a little bit more prolonged. So that's kind of my 2 cents on it. But I would not look at crude oil right now and say, okay, the Fed needs to be trading on that. That is very dangerous. Yeah, going into driving season.
Yeah, I kind of agree with you there, KG. It's going to help the data that's coming down the line. But remember, that CPI, that PPI that came in below expectations, a PCE kind of weaker than expected, is the fact that that's backward looking. So we're still not feeling the impact. I think that's one of the key things that KG's kind of mentioning here, Kev, is the fact that, hey, there's still so much uncertainty out there because a lot of the impact from the tariffs isn't in the data. It isn't in the earnings yet. And that's going to be when maybe, the Fed has to kind of be at the ready moving forward in case we do get that deeper economic slowdown that some of the numbers are already showing, right?
4 years ago, there were tariffs, and it didn't cause any inflation at all.
Was it 145%? Wasn't 145%?
Those are. Do you honestly feel that there's going to be a 145% tax, or is that a negotiating ploy by the Trump administration to get China to the table? I think even Scott Bessent said that level is unsustainable. China has already taken off their 125% tariffs, so the negotiations have already begun. You have to be able to look at the world that we live in and see the chess game being played versus the checkers game. And you can play what you want, but the market just rallied back about 15%, and everyone was still bearish. Nothing really changed. So I'm trading the data that's in front of me. And by the way, when inflation was skyrocketing, it was energy that was making it skyrocket. Energy was leading it up, and it's now leading it down. Ignoring energy is ignoring one of the key factors in headline inflation. So, hey, everyone's got their own macroeconomic triggers that they watch. That's what I watch.
Yeah, KG, and to that point about crude oil coming down, that's going to flow into a lot of the data that's coming up on inflation. Because remember, when they started talking about the tariffs, we saw a lot of volatility in the Treasury market and yields. That caused a lot of volatility for the equity market. But if those numbers on the inflation front that everybody keeps talking about, this is going to spur more inflation. Well, if you have an easing of economic activity out there, maybe those offset each other, and then you throw in on top of it that crude oil's $11, $12 off of those levels that it was on April 2nd, it's going to come into the numbers where, hey, maybe a rate cut in June or July is going to be warranted at that point, and they can kind of take care of it when they get the data.
Yeah, I see. Once again, I'll go and push back against that. And maybe it's just I focus on crude a lot.
Yeah.
So a couple of things that's happening with crude oil. You're getting very close to break-even levels for mid-cap and small-cap producers here in the United States, the Permian Basin. You have a policy right now that's really trying to focus on Saudi crude being brought here in the United States and increasing heavy sour crude. What's going to happen with those break-even points when we get fairly close to these levels, you're going to have production pretty much drying up here. You're going to have the expansion or the lack of expansion in Oklahoma and in Texas. That's going to lay off a lot of workers. You're also going to have the impact when it comes to the equipment that needs to be purchased right now. And a lot of the equipment for oil services companies come from China. And so you either purchase that beforehand and you know, well, prices are going lower, my margins are going to get eaten, or you don't purchase it at all and you still have this tariff policy. And then you're also going to be looking at the job losses in the energy patch just in general. So when you focus on oil, you can't just look at that as, man, oil's going down, everything's going to be fine. If you actually look at retail gasoline, it hasn't even moved not nearly as much as NYMEX gasoline, which is being quoted by the White House here. And that probably won't happen. Crack spreads look actually better this time than we had last year. Refiners are probably going to do perfectly fine here. And so if you don't have that ease and pressure, I just don't feel like you can hold your hat on that. Last thing I will say, it was energy prices and it was also supply chains. We cannot forget the fact that supply chains were messed up for 2.5 years, causing also disruptions and pressures on inflation. So we can have the energy conversation all you want. I can guarantee you this, I would be very shocked. I would be very shocked if we have crude oil. I would be very shocked if we had, I believe crude oil probably will go down and hit 45, 46, maybe $50 a barrel. I will be very shocked if it's at that level this time next year. And you got to think about the other side of this and say, okay, well, when it goes back up, is it going to be the result of this policy, or are we going to blame the Fed because they cut too early when crude goes back up to $75, $80? Because it will happen. It's not like prices are going to stay at these levels for the next 4 years. Yep. That ain't going to be the case.
All I got to say is I'm glad my energy or my gas prices are lower. Go ahead, Kev.
One last thing. Remember what one of the largest expenses is in the cost of goods: transportation. Every transportation bill in this country is going down because of lower crude oil prices. You think that'll lead to inflation? Probably not. That's one of their big expenses. Airlines, cruise ships, anything that moves something from point A to point B. If you have lower expenses in terms of energy, you have lower expenses.